Today in SERDNA Talks, we're going to talk about money and real estate. Let's say that you need a lot of money, but you don't have it with you. Or perhaps you do, you just don't know anything about it. But if you have a property or two or three or four or five or 1,000, and if you need to come up with some cash fast because you want to go on vacations after this endless lockdown, or what if you have a leaky roof after the last hurricane season and you need the money to make the repairs? So if you own 10 or 5 or 100 or a million properties or even just one property, you have the opportunity to use or tap into your home equity. If your property is worth, let's say, $800,000, and if you only owe 100,000, then your equity is basically 700,000. Very easy, but that doesn't mean that you will be able to cash out that amount. And there are many ways that you can get money out of your properties, and that's exactly where we are going to talk today in SERDNA Talks. We're going to talk about HELOCs, or home equity lines of credit. We will talk about home equity loans and cash out refinance. And after seeing this video, you should be able to understand 100% which of these three options is right for you. Let's start with HELOCs. A HELOC makes the most sense if you want the flexibility and peace of mind of knowing that you can easily access money in the future. A home equity line of credit is basically a second mortgage that lets you pull out your home equity as cash. So be careful. Since it's a second mortgage, your HELOC will be treated aside from your existing mortgage. And with a HELOC, or home equity line of credit, you have the opportunity or advantage of pulling out the amount you want any day that you want, just like a credit card or a debit card. And you don't need to withdraw the entire amount. And you will make payments only on what you actually use, not on the total credit available. You will be basically borrowing as much as you want, whenever you want, to do whatever you want. So if you're thinking about getting a HELOC or a home equity line of credit, then every single month you'll have to make two payments, of course. You will pay for your mortgage as usual, plus the HELOC amount. And HELOCs can be good because you will borrow only what you need. You will pay interest only once you start borrowing, but you can keep that line of credit open for many, many years. So talk to your bank to see for how long you can keep it open. And that's very helpful because that means that your HELOC can be ready just for a rainy day. Another good thing about a HELOC is that they might have low interest rates, and sometimes they have no closing cost, and when they do, those are usually a small fee. So don't worry about that. One thing that you need to be aware of is the fact that HELOCs usually have adjustable interest rates, and that could be very, very tricky since you will never know how much you're going to pay every single month. So be careful because your bank will be very happy if you stop making those payments, since they can and will close on your property immediately. Now, let's talk about cash out refinance. You'll have to pay for closing costs when you refinance, and those could be between 2 to 5% of the loan amount. If you need cash in your hands, a cash out refinance is the best way to go. You can use this money for whatever you want. And if interest rates are on your side, if they are lower than when you first got your first mortgage or your loan, then you will be able to lock those low interest rates. So you should definitely take advantage of that. And they only work if you have equity in your home, either through appreciation or paying down your mortgage. And they will replace your existing mortgage with a new loan that's larger than what you currently own to your loan servicer. And that will put the difference in your pocket. So you will be basically receiving a lump sum of cash during the process, and you'll be starting over with a new loan. And that could be bad because you will basically starting from zero. A cash out refinance makes the most sense if you are able to get a lower interest rate on your new loan. And this option also works well for home renovations since you will be using your home existing equity to help pay for even more equity growth, which is just incredible. And you can use your cash out refinance to pay for anything. And financial experts, they say that, or they advise that you spend the money wisely on something that you see as a good investment, something like this awesome Porsche. Now, let's talk about home equity loans. They are an additional mortgage that lets you tap into your home equity just like a HELOC basically. And with a home equity loan, you will get all your cash all at once, and then you will repay the loan in monthly payments. Just be careful, because if you miss one payment, the bank will try to foreclose on your property immediately. And interest rates are usually fixed, which is just unbelievable. They're not adjustable. So you know exactly what your monthly payment will be for the life of the loan. And a home equity loan is best if you prefer fixed monthly payments. And HELOCs are better if you want access to your equity that you can pay off quickly. If you have questions, remember to subscribe to SERDNA Talks and to share all my videos with your friends and family. I have to go. See you soon. Ciao.